Hi, everyone. Rich Saperstein, Chief Investment Officer of Treasury Partners. Today, I'm going to discuss our outlook on the stock market for 2026. Before I do that, I think we have to go back in time and look at how we got here. Remember, 40, 50 years ago, we were a manufacturing economy. We produced goods and exported them. Today, we are more of a services economy. Healthcare, technology, and that has changed the complexion of the stock market. At the same time, let's look at the Fed. The Fed pursued a zero interest rate policy for 15 years. At the same time, it changed its mandate somewhat and actually now engaged in quantitative easing, where it purchased bonds out of the market and added to their balance sheet, further stimulating the economy. So the combination of the change in our economic activity from industrial and manufacturing to services and technology, plus the advent of free money for a long time, drove market multiples higher. Today, 50% of the stock market is dominated by 10 companies, and 40% of the market is really large cap tech right now. So the whole complexion of the stock market has changed. We have to recognize that in our investment activity. In evaluating the merits of investing in the stock market today, we typically look at three factors. One is the fundamentals, two is what the Fed is doing, and the third is geopolitical aspects of what's going on. Fundamentals look solid, all right? We've got inflation declining. We've got modest to strong economic growth. Unemployment is weakening slightly, but in general, economic activity is brisk and will continue to receive the benefit of the high-end spending as well as the AI infrastructure cycle that we're in right now, petering through multiple parts of the economy. So from an economic fundamental standpoint, it's positive. We look at the Fed, as everyone knows by now, Trump will be replacing Powell with someone of his choosing that likely will be more accommodative. So we expect the front end or short-term interest rates to move lower. At the same time, the question is what's going to happen with the bonds that they're actually now buying again through a restarted QE program. We believe that could actually be ended by the new Fed chair. If we do see a new Fed chair that lowers interest rates on the front end, our expectation is that the longer end of the yield curve, longer term rates will tick higher. That will result in a steeper yield curve. So we expect long-term 10-year rates to move higher, likely to the 450 area, while the front end, the short-term rates, moving lower, probably down another 50 to 100 basis points by the end of the year. When it comes to the geopolitical environment, I think we can safely assume that POTUS will create volatility for stock market investors this year. Look at what happened this year with his announcements on defense contractors unable to pay dividends or return capital to shareholders, wants to limit credit card interest rates for a year at 10%, prohibit institutional investors from buying single-family homes. So I think Trump is leaving no stone unturned to try to get the economy more affordable. Obviously, we're going into a midterm election, and that likely plays into his thinking. So expect much more volatility out of POTUS relative to the stock market. And obviously on a geopolitical front, we have the Greenland situation that's flared up now, and that's causing angst amongst investors. Our view is to sit on your hands and not take action on that because it's going to end in one way or another. It's a self-inflicted event, much like we indicated last April when tariffs Liberation Day was announced. Again, self-inflicted event that the market would look past. So I'm going to stop there before we get into specifics on different sectors.